Well, I think that's exactly the reason why I would take risk in this environment, because central banks have told you that they are going to continue on an easy monetary policy and cutting rates. You have to be willing to withstand the volatility that we saw in August. It'll happen again, if not September, October, November. But you will get paid to take risks because central banks are forcing you to do it through lower and lower rates.
And if that's the case, then where would your bias be? You're saying Asian markets are expected to remain volatile. So within equities, where would you buy and what are the sectors that you're looking at?
Sure. Well, look, I'm a bond manager. We focus on the more conservative sectors, even of the bond market. And it's very rare that you'll hear a bond manager say positive things about equities. But in general, I think this is a good environment to take risk in global equities because central banks will be cutting rates. In Asia, we're seeing it almost across the board. In Australia, we're based here, so maybe slightly biased toward Australia, but with the Reserve Bank of Australia likely cutting rates another 50 basis points over the coming year, I think you got to like the equity story in Australia. We like the equity story in Korea. Again, that's a story of lower and lower rates. And the volatility that comes, really, the risk is that something else happens. Either the trade war gets bigger or the Fed doesn't cut rates to the extent that markets imply. But I think that that's very, very unlikely. So I think in general, you've got to take risk in this environment, and that means hold equities globally.
What are you taking away from the inversion in the yield curve, Steve? Why do you think that the yield curve is inverted?
Well, I'd take it's a combination of things. The biggest story is there's no inflation as far as the eye can see. I don't think that actually, the inversion of the yield curve between the 2 and the 10-year part of the curve and signaling a future recession, I'm not a believer that that's really a part of the story. I think you have supply-demand imbalances in treasuries where a lot of the treasury issuance has been shorter dated, not longer dated, and there's been a dearth of supply in the long end of the curve, which is part of the yield curve inversion story. But in the U.S., the job growth story is relatively good. We're not seeing 200,000 jobs a month anymore, but we are seeing 160 to 180,000 jobs. So it's the consumer may be slightly on the back foot, but the consumer is still in a really, really good position. They have wealth in the house now, they have wealth in the equity, and they have income because they have a job. So I think the story is good. It's not great in the US, but it is a low growth, low inflation environment. It's hard for me to see a recession coming in the US absent some big policy mistake. That could be more tariffs or the Fed not cutting to the extent markets are expecting, but I think that's very, very unlikely. So the curve will remain flat because it's a low growth, low inflation environment. But as far as a recession, I think that's unlikely over the next year.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.